Welcome back to International Finance. I'm Andy Kim, your Dr. Finance. We are covering Chapter 14, Interest Rate Swap and Currency Swap. And this is a second video where we are going to go through the nitty-gritty detail of the swap basics, right? The chapter outlines look like this. And this is the types of swaps. We're going to talk about it. Big picture of a swap market in the global market, right? And the size of this, and then the swap bank, the concept, and swap market quotation, conventions, and then interest rate swap concept, and then currency swaps concept. We're going to talk about it. And then perhaps in the next video, okay? And then we're going to talk about the currency swaps. And then we're going to talk about variations of basic interest rate and currency swaps as well. And then risk of interest rate and currency swaps. And then finally, in the last video, we're going to talk about is the swap market efficient or not, okay? Now, definitions, right? Definitions. In a swap, two counterparties agree to a contractual arrangement wherein they will exchange cash flows at periodic intervals, right? It's about exchanging. Swap is about exchanging. A swap, exchange. Okay, over a certain period, okay, over a certain period. The principal amount stays there usually, okay, but the interest rate payment, those obligations are exchanged, okay. I am supposed to pay fixed interest rate previously, and you in floating rate interest rate previously, but we swap the contract, okay, so that I pay the floating rate interest and you pay the fixed rate, okay. So that's what's going on over here. Now, there are two types of interest rate swaps. Single currency interest rate swap, that's called plain vanilla fixed for floating swaps. Okay, and these are often just called interest rate swap, IRS, right? IRS. And then cross currency interest rate swap is also there. Okay, this is often called a currency swap. Okay, fixed for fixed rate. Debt service in two or more currencies. We're going to talk about one example over there. And then in 2015, the notional, the size of the swap market, right? In 2015, the notional principal of this market, okay, was huge. The interest rate swap was $289 trillion worth. Notional principal, what is that about? Well, I told you before, usually the principal amount, right? 원금 in Korean terminology, it stays there in your balance sheet. You don't swap it. Only your interest, periodic interest payment contract, that is swapped, that is exchanged. That now the notional principal is this principal amounts that you hold in your balance sheet, which doesn't change your ownership, right? Or obligation. That's what notional principal is about, right? Those swap transactions are, contracts are made based on this about $300 trillion worth, a huge amount globally. And currency swap, right, was $22.7 trillion worth, which is like less than a tenth of the size, right? And for the four most common currencies used to denominate interest rate and currency swaps are the euros, US dollar, Japanese yen, and British pound sterling. Okay, with the fifth most common currency being Canadian dollar for interest rate swap, and the Swiss franc for currency swap. Okay, now exhibit 14.1 shows you the size of OTC interest rate and currency swap markets, like over the counter, okay, over the counter. Total notional principal outstanding amounts in billions of dollars, right? You see billions of dollars unit, which is like over here, it's like a trillion if you punch comma, right? IRS and currency swap. Again, currency swap amount is, notional principal amount is 1/10 of a smaller, less than 1/10 of the IRS, right? A lot in going on over there. And then you see the size of going up or down a little bit, right? But it's there. Now, the swap bank, right? The swap bank is a generic term to describe a financial institution that facilitates swaps between counterparties, okay? The swap bank can serve as either a broker or a dealer, okay? A broker, the swap bank, as a broker, the swap bank matches counterparties but does not assume any of the risk in the swap. Whereas a dealer, the swap bank stands ready to accept either side of a currency swap as a counterparty and then later lay off the risk or match it with a counterparty. Okay? So dealer, I told you before, dealer is about having an inventory and then taking that risk in the long run. Okay? That's dealer. Broker does not have that book or balance sheet. Okay? Does not take the risk. Okay? So it's just a matchmaker and then bye-bye. Matchmaker, bye-bye. That's a broker. Okay? Dealer is I am the one who buy that or sell it. Okay? That's the difference over here. Swap market quotations. Well, swap banks will tailor the terms of interest rate and currency swaps to customers' need. One thing to tell you, we said something about over-the-counter market in swap. Why is that over-the-counter instead of being traded in open exchange, right? Like New York Stock Exchange or NASDAQ or whatever, okay? The thing is, to be able to be traded in that open exchange, right? These products has to be much more standardized so that it could be traded, bought and sold within a millisecond, right? The thing is, can you buy and sell the swap trends? Can you make a swap contract within a millisecond and then buy and sell it 1 over 1,000th of a second, right? Can you do that? The answer is no. It's complicated. Each structure is more complicated. You need some computation, and then it is tailor-made. So that's why it is difficult to trade fast. Okay. In contrast, the stocks, right? One common shares, one dividend right for one dividend payment. Very extremely easy to compute, or it's standardized, by the way. So that's why it is traded in open exchange. And call options, 3 months, 6 months, that open contracts, right? Put options, those things are traded in the futures exchange, right? Chicago Mercantile Exchange, CME Group, or something like that. That's, standardized one. But swap, no, it is tailor-made so that we need to transact it over the counter, OTC market. They also make market in plain vanilla swaps and provide quotes for these, right? Since the swap banks are dealers for these swaps, there is a bid-ask spread. Always, as long as there is a dealers or brokers getting in, the middleman, right? They are not doing this middleman job as a volunteer, right? They're not doing it for free. Okay, they have to charge some fees to you. And that is what the bid-ask spread is about. They make money, they make living out of this bid-ask difference, right? It shows like this: interest rate swap quotations, and euro, sterling, Swiss franc, and the US dollar, Japanese yen. 1 year, 2 years, 3 years, all the way down to 30 years swap contract. You see bid-ask spread of these things over here. If you look at this 25-year euro bid-ask spread of swap quotations, 1.06, 1.1, okay, means the swap bank will pay fixed rate euro payments at 1.06% against receiving US LIBOR, US dollar LIBOR, or it will receive fixed rate euro payments at 1.1% against receiving US dollar LIBOR for 25 years. So what is not being said is What is omitted is the LIBOR, right? LIBOR rate is a market rate, up to date. So whatever the LIBOR market rate may be, right? As long as you're swapping with fixed interest rate contract, right? Then fixed rate, okay? So that's 1.06 fixed rate payment. They're gonna take it, and then if you're gonna sell it, then the 1.1% has to be given to the swap bank, right? So bid-ask price, always the bid price is lower than the ask price. And then the difference over here, 0.04 percentage point or 4 basis points, that spread is what these swap banks takes and then earns money out of it, okay? Now, swap quotations, bid-ask spread, 1.06 to 1.1 means the swap bank will pay fixed rate euro payments at 1.06% against receiving US dollar LIBOR, or it will receive a fixed rate euro payments at 1.1 percentage point against paying US dollar LIBOR. Okay, so here's firm B and A, and then swap bank in the middle. And then firm A may want to pay US dollar LIBOR fluctuating or floating rate interest to swap bank. If that is the case, then in exchange, the swap bank will pay 1.06% fixed interest to firm A. On the other hand, looking at firm B, the swap bank may, in exchange for firm B's 1.1 percentage point fixed interest payment, the swap bank will be willing to pay the US dollar LIBOR floating rate interest payment. Okay, so the difference is what the swap banks makes their living for. Okay, while most swaps are quoted against flat US dollar US dollar LIBOR, off-market swaps are available where one party pays LIBOR plus or minus some numbers. All right, so the next one is about the example that I give you about HSBC and Starbucks, fictitious case, right? About fixed for floating rate interest rate swap. Okay, let's see what's going on over here. Now, HSBC, right? Hong Kong Shanghai Banking Corporation. Hong Kong Shanghai Inhang, right? Is the UK bank, right? The world's local bank, it says. Is in the UK, right? AAA rated. And it needs to raise $10 million to finance its floating rate Euro-dollar term loans to its corporate client, Rolls-Royce. To finance some Euro-dollar term loans to its corporate borrowers, it needs to raise some capital. Okay, it needs to raise some capital, borrow from somewhere so that they could lend to Rolls-Royce later on. So HSBC needs to borrow. Alternatively, HSBC could issue 5-year fixed rate Euro-dollar bonds at 10%. Remember here in the previous bullet point, it was they need to raise in floating rate bond. But in the second bullet point, you see it could issue, okay, 5-year fixed rate Euro-dollar bonds at 10% rate. And then bank balance sheet is all about asset liability management. So the second bullet point is about this. You have Rolls-Royce loan relation, which will be floating. But to finance that loan, okay, would you borrow your money in a floating rate market or in a fixed rate market? Okay, you want to be in sync, right? The asset and liability moving together, interest rate exposure is together. Okay, then you will be safer. But if you have to borrow at fixed rate, whereas your loan is in fluctuating rate, then your exposure to the interest rate risk is huge. So that's a problem. Okay. floating debt should be matched with floating assets, interest rate risk management or minimization. Okay, so that's the need for HSBC right now. Now the next slide is about Starbucks, right? Starbucks. What about Rolls-Royce? Man, forget about that. That's just the asset side or loan side of HSBC. What we are focused on is about their liability side of HSBC as a counterparty, as just a counterparty of a swap transaction over here. The other side of the counterparty is Starbucks. Starbucks, BBB rated, a US company. It needs to raise $10 million US dollar to finance its capex, capital expenditure, with a 5-year economic life. Okay, it can issue 5-year fixed rate bonds at 11.25% in the US bond market. Alternatively, it can issue 5-year floating rate note at LIBOR plus 0.5 percentage point only, or LIBOR plus 50 basis points only. All right. Assumption that interest rate is anticipated to rise in the future. Fixed rate debt would be optimal for Starbucks to lock in the financing cost. So as long as in the future, if the interest rate will go up, just like today's situation, right? Interest rate seems to go up because of this time it's about the inflation worries, right? But if we have this kind of situation, well, you want to borrow at fixed rate today, so that the interest rate 1 year from now or 2 years from now will be higher than your actual borrowed rate of today. Okay, that's the need. You want to borrow. Starbucks wants to borrow at fixed interest payment scheme, whereas HSBC, they want to borrow at the floating rate scheme, right? So the quality spread differential, that concept gets in over here. The key to swap is that a QSD, quality spread differential, exists, which is defined as the default risk premium differential on the fixed rate debt and that on the floating debt rate, the differential of premiums, right? So what is this about? Well, the yield curve is steeper for lower quality debt than high quality debt. Okay, so yield curve, what do you mean about yield curve? It goes back to your investment class. Here is the time to maturity of your borrowing and on your horizontal axis, and then the vertical axis is about the interest rate. Okay, interest rate R, and then this time to mature as you have as the maturity of your borrowing goes longer, right? Longer horizon borrowing, naturally you will have higher interest rate to borrow compared to your short-term interest rate, right? But for bad quality, poorer quality or higher credit risk companies, right? When they borrow money for the same maturity, they will have to pay higher interest rate than, let's say this is triple B companies, this is AAA companies. This, okay, is a credit spread. Okay, so at the lower maturity range, the differential is not that big, whereas the higher longer maturity, the differential, okay, the difference over here is bigger, okay, compared to this one. That one is bigger in the longer maturity. So the differential is represented with this delta sign over here, delta, this difference. So QSD is defined as fixed rate differential minus floating rate differential. So if you look at the Starbucks and HSBC, each company's borrowing rate looks like this. At fixed rate, Starbucks is 11.25 percentage point, whereas HSBC is as much as 10 percentage point. Okay, this is a fictitious example, so for pedagogical purpose, right? The differential is just this minus that. That's 1.25 percentage point. Make sense? Yes, this. Now, how about floating rate market? Starbucks can borrow at LIBOR plus 50 basis points, whereas HSBC, they can borrow at LIBOR rate. So minus this guy, which is 50 basis points. That's the differential in floating rate. What is the QSD? That's this guy minus that guy, which is 75 basis points. All right. There is a room, okay, for swap transactions, right? There's a room as long as you have enough of, QSD. So the next diagram shows how this HSBC and Starbucks can strike a swap contract, okay, given their situation. Now, HSBC, they can borrow at LIBOR rate, fluctuating the floating rate market, right? For the same amount of money they borrow. And for the same amount of money, the Starbucks can borrow at the fixed rate debt market, euro-dollar bond market at 11.25 percentage point. That is our starting point. I show you with a straight arrow if it is a fixed rate market, and then the wiggly arrow if it is a floating rate market. Okay. And then both sides, I mean upper side, I show you a fixed rate market, and then lower side, lower part, I show you the floating rate market, LIBOR plus rate. Okay. So both companies, right, if they try to go to the alternative debt market, HSBC can borrow at 10% fixed. If Starbucks choose to go to the alternative market, they can borrow at LIBOR plus 50 basis points in FRN market. Okay. Now what? Well, it seems like it's better they choose to go to the alternative markets and then swap it. All in all, their interest expense will be minimized or reduce their borrowing cost, right? So that means for HSBC, if they choose to go to the euro-dollar bond market at 10% fixed rate, which they can borrow, okay? And then Starbucks, if they borrow at floating rate note market at LIBOR plus 50 basis points, right? What can they do? Well, they can switch their obligation. For Starbucks, right? For Starbucks, they wanted to have a fixed interest payment debt, right? So instead of going to this high rate of fixed rate of euro-dollar market, why don't they just borrow the same amount at the floating rate market, but pay their fixed interest amount of fixed interest of the range from 10% to 10.75 percentage point. They just pay this amount to HSBC. In exchange, HSBC borrows from the fixed rate bond market at 10% and then swap the interest payment obligation to the Starbucks so that they will pay floating interest rate of LIBOR interest amount to them instead of just directly borrowing from the LIBOR market. Okay, so there, what happens? Well, how do you know any fixed rate between 10 percentage point to 10.75 percentage point will serve their purpose? Well, for Starbucks, right? For Starbucks, the cost of funding smaller than 11.25 percentage point will make the company happy, make the CEO happy. Okay, so the interest cost of funding, let's put this as RX. Okay, that's unknown interest rate. Okay, unknown interest rate. The Starbucks has to pay as a fixed interest in that swap contract. Okay, RX. Let's say that's this guy, RX. Okay, that's this guy's obligation to HSBC in this swap contract. What is that? Well, the Starbucks total or net, right? The Starbucks net interest expense using this swap contract would look like this. They have to what is it? They have to pay LIBOR plus 50 basis points every year, okay? And then they receive LIBOR interest from HSBC, which is going to be minus. And then they will have to pay certain RX interest fixed to HSBC. So net, that's LIBOR plus 50 basis points minus LIBOR plus RX. You see, this is about the cost going out, okay? So the plus means expense, minus means income or revenue, okay? Plus minus plus. RX, if you do the math, you will find that it's going to be RX plus 50 basis points because LIBOR cancels each other out, okay? And then as long as this total net interest expense is smaller than 11.25 percentage point, the CFO will be happy in Starbucks. And that tells us that RX has to be smaller than 10.75 percentage point. That's our first condition. Now, if you look at the same situation from HSBC's perspective, the cost of funding being smaller than LIBOR will make the CFO of HSBC happy. Yes, HSBC, the banks also have CFOs, by the way. Anyway, if you look at the interest expense and income of HSBC, they have three components to net out over here, 1, 2, 3. What are those? If you go back one slide over here, they have to pay 10% fixed every year. So plus 10%. And then they have to pay LIBOR plus LIBOR, and then minus RX, which is unknown over here, right? So the next slide is this about 10% plus LIBOR minus RX. As long as this guy is less than LIBOR, which is the original situation where the HSBC just simply go to the floating rate market, right? Then what happens is RX should be bigger than 10 percentage point. So condition 1 and condition 2, if you combine those two, then you will realize that any interest rate of RX, the fixed interest rate, being between 10% and 10.75%, will make the CFOs of Starbucks happy and the CFOs of, or the bankers of the HSBC happy as well. Louis Joko, Bebo Joko kind of situation. Both parties are happy, right? So that's that. And then that difference is 75 basis points if you look at it. The gap, 75 basis points, which is over here, QSD. Yeah, that's that. Now, yeah, for example, 10.5% could be a solution in this situation that satisfies this condition, 10 and then 10.75%. And then if these two guys meet each other directly and say hi, yeah, hello, HSBC, hello, Starbucks, and then they just shake hands and then do their own, right, swap contract, that's fine. That's when the HSBC works as a dealer, I guess, right? Partly dealer, and then satisfying their own funding needs like that. But usually this does not happen directly. You need some middleman, okay? Middleman, like for example, Societe Generale gets in there as a swap bank, right? Swap bank as a middleman, and then boom, and then say what? Well, Mr. HSBC, okay? Give me that LIBOR rate, right? You borrow from that fixed 10% fixed borrowing market, okay, euro-dollar market, and then pay me LIBOR rate. And I'll pay you 10.375 percentage point, okay? Periodically. So that HSBC's net interest payment will be what? If you do this math, right? HSBC's payment LIBOR over here to the swap bank, and then payment to the euro-dollar market, okay, fixed rate 10%, and then receiving fixed 10.375% from the Societe Generale. And what you will see is that the net payment turns out to be, this guy, LIBOR minus 37.5 basis points, which is lower than before. And then the HSBC will be happy, right? It's better than this. Now, what about the Starbucks? And this guy go to Starbucks and say what? Well, Mr. Starbucks or Miss Siren, you pay me 10.5 percentage fixed interest instead of paying the 11.25 fixed euro interest, right? In the euro dollar bond market, right? It's better lower, right? Just pay me that one. I'll give you a LIBOR rate. Instead, you borrow the same amount from the floating rate note market, which is LIBOR plus 50 basis points for you. So the net payment for Starbucks becomes 11% because that's 10.5 percentage point plus LIBOR plus 50 basis points. That arrow that goes out of this box, right? Those are the costs, right? Sum it up. And then the interest coming into your company, that's this arrow coming in, that's LIBOR fluctuating. And then whatever fluctuating LIBOR it may be, they cancel each other out, so that if you net it out, you will realize this is only 11%, which is still better than 11.25%, right? So both parties would be happy. And how about swap banks business? Well, they have to pay 10.375% and LIBOR to mutual parties, right? Fixed and then fluctuating. And then receives what? Fixed 10.5% and then fluctuating LIBOR. So LIBOR cancels each other out. And then what is left is minus 0.125 or 12.5 basis points. That's minus cost, which means profit. Okay, so swap banks makes money out of it. Okay, that's the spread between these two. Okay, the difference between these two. Okay, so that's basically it. And then after this pictorial example, I'll give you a numerical example, and then we're going to discuss that in the next video. So wait for that. Thanks for watching. Bye.